Hey there, welcome back to my channel. So last week we talked about how you figure out what the options percentage rate of returns is on premiums. So what we did was we took some tickers, we noted if they passed my stock buying and trading system, which I'll explain briefly. We figured out what a cost of 100 shares was. I figured out what we could get paid for a 3-week just out of the money premium. On a covered call, we figured out what the cap gain would be if we got called away, and we came up with a total. From there, we used our rate of return calculator and figured out what the rate of return was on that 3-week option if it was a covered call and if we got called away. Okay, so that's what we did last week, and we came up with all of these percentages. So the stocks all have different percentages that they yield, but some of them sort of like grouped together in the same range. Some were about 2%, some were 2.5, some were 3, some were 5, some were 6, some were 7, okay? So it goes all the way up to like 11 or 12%. And what I want to be here to say today is that this is part of the equation on how you figure out what you want to options trade, but it's not a full part in my opinion. So for me, with my system, this is what I do first. The first thing I do is always go to the stocks chart and look at the 5-year, 1-year, and 3-month chart, making sure those charts are all going up. If it passes that test, then I go and find out what the earnings and revenue are for that stock 4 years in a row on Yahoo Finance. There's a little financials tab there on Yahoo Finance. You plug in your ticker, you go to the financials page, and it'll just bring it up, the year-over-year returns for earnings and revenue. Those have to be going up every year for 4 years in a row in order for me to want to trade that stock. The last thing that I consider, make or break, is that stock an industry dominator, a monopoly, or like a mega cap? If it is, it passes another test for me. So again, that's my stock buying system, and there's a whole YouTube series of videos on that you guys can check out. It's called Investing for Financial Freedom. Very worth checking that out because you'll have a stock vetting system that will work really well. So on my notes here, I flagged whether these stocks pass the system test or not. Okay, so if they're green, I'm interested in potentially options trading these. If they are orange, they have been in the past, but they've had a little bit of a bad quarter. So I'm not getting any new positions with these. And then for giggles, I thought I would include some that don't meet the charts right now, but do show like a rate of return that can be quite interesting for people. Or some of these stocks are very hot in social media platforms, and I thought, hey, we should discuss why they are and why we should steer clear of them, like why I'm steering clear of them. Okay, so just Kava has bad charts. The 5-year, 1-year, and 3-month are not all going up. I think there's 2 that are down, which is a red flag. Coin is not even 5 years old yet, so that's a bad thing. Their earnings and revenue are also off. I don't believe their charts are great either. SoFi just started having good charts. They just started being over 5 years old. So for me, that stock has more time to prove that they are a winner for me to get involved with it. And ELF, I do feel, is a little bit of premium chasing as a stock. So that's something we're going to get into in this video, is what is premium chasing and like how can I avoid it, right? How can I avoid that? ELF's charts are actually okay. I didn't look at their earnings and revenue, to be honest with you, because as soon as the chart's bad, I don't go any further. But the premiums are very good. And so that's what gets people interested in trading a stock like ELF, is they look at the premiums and they go, oh my gosh, I can get $1,095 for a 3-week covered call. I can't go wrong on that. Yes, you can. If the stock is falling and has been falling for 3 months or a year, the stock can continue to drop, which means that you're going to have a hard time getting your cost basis back from those shares. So why would you go there? Makes no sense to me. I personally wouldn't, and I have been stuck in situations like that before, and it's been awful. So that's why I don't do that. But, so that's premium chasing, and that's something that we want to avoid. And how do we know we can avoid it? Well, I do this work. I figure out what the percentage of returns is, and I also figure out for my Investing for Financial Freedom, that set of videos, my stock vetting system, like, does it pass the test or not? If it does, then I start to do something called allocation in my options portfolio, okay? So I'm going to tell you a little bit more about how I allocate my portfolio. So stocks that have a lower rate of return, you'll notice, usually pay a dividend. And they are companies that have been around a really, really long time, and they have solid names. So let's just start off the top here. This is WM. This stock is actually, let's see, is this one is Waste Management. This is its 5-year chart, okay? Looks pretty fantastic. It is up 77% in 5 years. When you break that down year over year, it's not much every year, but the thing that's so great about the stock is that it pays the dividends, so you're getting dividends if you're holding, and then additionally, like, this stock isn't going anywhere but up, generally speaking. In fact, this stock had some of the best COVID charts I've ever seen. So most stocks like fell off and got dropped like a hot potato when COVID happened. Waste Management did not fall very much. It's very stable. It's so stable, and that's why people are attracted to it. The same is true for Walmart, which we're going to review in a second. The same is true for sometimes Home Depot, MasterCard, and Visa. Okay, so these are companies that are growing slowly, and the options premiums aren't huge on them because there's not a lot of volatility in that stock. They maintain their value within a range. So you're being paid to do options with them, but you're not being paid as high of a rate of return because the market makers that assign options pricing through help of their algorithms and their computers, they're paying you to take risk, okay? That's what options premiums are. You're getting rewarded for the risk that you take on, okay? The more risk that the market makers see in that option, the more they'll assign for it, for the payment, for the premium, okay? So anytime you see a very high options premium, that your brain should immediately go, oh, there's a lot of risk here. That's what the market makers are telling me, because that's what they're telling you. That is what they're telling you, and that's what they're telling me. They're also telling me in Waste Management, Costco, Visa, and MasterCard, there's not a whole lot of risk there, and there's not like a whole lot of volatility. Okay, I think Costco does have more than the rest of them, but it's just, it loves to bounce back. So this is just one of those things that you need to know about the market. So we're going to switch over and look at some charts to show you more of what I'm talking about. So I have the 5-year chart up for Walmart, and this is a stellar chart. The rate of return in 5 years has been 143%. It's pretty great. And it's a constant riser. I mean, sure, it has these things where it falls off here and there, but it's really taken off in, like, say, the last year. This stock pays a dividend, which gives it added stability. The 1-year chart is up 71%. So again, a lot of this growth came in the last year, which is pretty fantastic for Walmart. But there isn't like a whole lot of volatility here. When you look at this, it's just kind of moving between $64 to $70. It's staying in the same range, and then it breaks out. So it's had basically fantastic earnings reporting coming in, and then it's breaking out after that. That's what's happening here. But this stock, to me, looks like a fun stock, an enjoyable stock to options trade in a very light way. And it looks like it's a portfolio stabilizer for me, and it's a portfolio grower. That's what these charts are telling me when I look at them. Okay, so this, to me, is a great stock for somebody who wants to trade options in a very conservative way. Okay, they're going to be rewarded some money for options traded. They're not going to have the same returns that somebody with an NVIDIA and Meta portfolio does, because that's super volatile and super high premium. But the thing here is that what you need to do as an options trader is think about your personality as an investor and as a options trader. If you are someone who comes into your account, like let's say you came in on Monday and you deposited $200,000, and it would shock you to see your portfolio go down to 160 2 days later. Stocks like Walmart and Waste Management are probably better for your allocation because they don't tend to do that. They move very slowly, and they aren't subject to these massive drawdowns, like massive drawdowns, okay? That doesn't really happen so often with these stocks. I'm going to show you Waste Management now. We're going to skedaddle over there. So Waste Management has more hills and valleys than Walmart, and typically this happens when a stock becomes more expensive. So this is very normal to see here. And in the past 5 years, we've had a 77% return, and then the 1 year is 14%. So again, like a stock that has very modest premiums, 14% is about what you're going to see, or lower premium is about what you're going to see that stock grow usually in about a year. Like that's a very normal rate of return. And we're not necessarily looking for these stocks that are the more conservative stocks for your allocation to grow tremendously in a year. We don't need that to happen. We just want them not to fall off. That's the goal. Because there are so many trades I can see doing in these peaks and valleys. It gets me very excited to see something like this. When I look at the Walmart chart, I also get very excited because I can see things, ways to place trades here with my system as well. So the thing is that what I want everyone to come away from this video with is that there are different rates of return based on different stocks. And you need to think about, does this stock match my personality, okay? So these stocks are more conservative. They're just going to keep your portfolio in the same range, reasonably speaking, when the market stays the same. If the market pulls back dramatically, yeah, they're going to pull back. But on a general day-to-day basis, they're going to stay in sort of like a range that doesn't fluctuate that much, okay? The next set of stocks that we're going to go into are these stocks that are more in the 3 to 4% range. And for me personally, I really love this range. I don't tend to go into too many of the conservative ones, but I do think the older I get, the more I'm going to be interested in doing that. Because my portfolio will be so much larger and I'll want the stability. I won't want to think my money's going anywhere, okay? So I like the idea of my money being pretty safe, in my opinion, in waste management the older I get and taking in less premiums because my portfolio would probably be like 4 times the size then, okay? So it's usually like when you get money, you want to keep it longer the older you get. Okay, and you don't want wild fluctuations because that can be a little scary if you have now quit your job and doesn't have any other income. All right, so Amazon, 5-year chart. Okay, this one's a little goofy because it did have this massive COVID fall off thing, but it's been a killer company ever since then, and everyone knows Amazon, right? And they just keep buying up every other company that exists out there and competing in spaces that, I mean, what space are they going to compete in next? We don't know, but they will. They'll find one, okay? So this chart has gone up 49%, almost 50% in the last year. The premiums here are really nice. This is moderate premium. There is nice volatility in this stock. When I say nice, it's just sort of like it goes up and down in these ranges for periods of time. It pulls back dramatically and then it kind of goes in the same range. And it becomes very predictable in a way to trade this as an options trader. This has been one of my favorite stocks to trade because it is so predictable. It trades in range and then it breaks out. When it breaks out, I take a little bit of a breather. I wait for a new pattern to emerge and then I jump back in and I start trading once I see that pattern emerge here. So we've recently broken out again and I'm finding that the new highs are 232 and the new lows are like 220. And so when I see my portfolio fluctuate, I wake up one morning and it's down 10K or something like that. I go, I wonder what Amazon did. And it's down 220, right? It went down to 220. And when I see it pop $20,000, I go, it's up to 235. So those are the kinds of swings that I see in my portfolio because this stock is doing the normal thing of going up and down. That normal thing of going up and down creates a lot of opportunity for me to make money as an options trader. Another stock that is in that range that is more moderate risk, that's what the market makers are telling us by assigning those premiums, and has moderate premium payments of the 4%, which is great, it's fantastic, right? It's Chipotle. Now this one is a little bit different of a chart when you see this. So the year return is 19%, the 5-year is 217, that's pretty nice, right? So, but it's kind of like going through these larger hills and valleys. This one seems less fun for me to trade, but I will tell you, because if you had bought shares up here and you've waited a long time, but this is moderate premium and it's in a price point that a lot of people can trade. So if you have a $10,000 account and you want to start somewhere, this is kind of an interesting moderate premium stock to trade. So this, again, moderate premium. And so if you are someone who wants a lot of stability in your portfolio, you could do something like trade 80% of your portfolio in waste management and Walmart, for example, and trade 20% of your portfolio in Chipotle and Amazon. You see what I'm doing here? So rather than picking something that's I'm going to be all in on a certain on like I just want 4%, I just want 4% from everything, and I want to go all in on Amazon and Chipotle to get 4% or somewhere around there, right? I can mix and match in my portfolio to make it mostly conservative with a little bit more risk, like moderate risk. That's some way I can structure my options portfolio. So this is what this video is for. Allocation is something that you need to think about. And I've given you the steps on how do you like choose if a stock is great or not? Okay, how do you figure that out? Okay. Next, what's the rate of return? How do we figure out how much these stocks even return for us? Okay, that's step 2. Step 3 is, what's my allocation going to be? What's my personality? Does it bother me to see my portfolio like go up dramatically one day and then down? Or do I see that as an opportunity to make a lot of money? That is unique to you. That is unique to you. It's unique to me. The answer for me is never going to be the same as it is for you, and that's okay. No one can ever tell you what the right amount of risk for you is. The only thing I can say about risk is if you get a little sick to your stomach feeling when something happens, your risk tolerance isn't as high as you previously thought it was, and so you should make some adjustments from there. All right, so now we are going into the higher premium, very, very high premium stocks with Meta, which this stock has been, here we are getting into the stocks that have really high returns on their 5-year. And you are being rewarded for being in these stocks because a lot of times people, I don't know, maybe not me, but certain people feel that when a stock is on a run for 5 years, maybe it can't grow anymore. So this is one of the reasons why these premiums are higher. So it's 180% in 5 years, and this last year is 60%. So a lot of that return came in the last year. This is this is true of this market that we are in for a lot of these mega cap stocks because we had such a dramatic pullback in 2022. And so 2023 and 2024, which we just finished, we're now in January 2025, were retracement years where these stocks retraced their losses from 2022 and then started to grow from there. So that's what we're reviewing all this information on. That's where we are in time. So Meta really is one of those things where you log in your portfolio, and some days you're really up and some days you're really down. Okay, so if that's not for you, then maybe don't trade Meta. But if you like Meta and you don't mind these hills and valleys and you see them as an opportunity because you know that you should buy a Leaps contract here and sell one here, or you should set up put credit spreads here, then it's a really great pairing for you if you like the amount of risk that this stock offers and the amount of volatility that it offers. So again, we are being paid premiums based on the risk we're assuming and based on the volatility in that stock. So you get paid more to stomach that roller coaster of the stock moving up and down. That's what you're being paid to do. All right. So that's Meta. So you can see here, these swings are pretty big. 539, then down to 453. So I mean that's like a fifth of the value of the stock gone. Boom. In just like 2 weeks or something like that. And it does that frequently. It does that several times a year, and you just have to be cool with that. Another stock that we're going to look at is Nvidia. This one has just been the talk of the town for the last couple years. I mean, the 5-year chart, again, I mean, have you ever seen anything like this? This is like, it's the talk of the town because it's very rare that you ever see a stock do something like this. That is that is really contributing a lot to society versus it not just being a pharmaceutical drug company that just came out with some like cure or something like that. This seems to be like something that's going to be around for a while. It will remind a lot of people who are older of Cisco. So if you don't know that story, look it up because it's interesting, because Cisco did fall eventually and dramatically as well. So that's the thing. You're being paid a lot on Nvidia because there's a lot of people that are speculating right now, hey, after a 2,267% run in 5 years, it can't stay there. I mean, That's not necessarily my opinion, but that's other people's opinion. I don't know what's going to happen. You can see that I definitely have a lot of shares in this. I do like this stock. I do trade it a lot. But this is very, like, when we look at this chart, it's very toothy. There's a lot of ups, there's a lot of downs. And again, like, you know, some of this isn't comfortable for people. But the premiums are there. The premiums are there if you want to assume this risk. So, you know, what are you going to do with your allocation? That is completely up to you. You could do something like have 30% of your portfolio in like an Nvidia that's higher risk. You could have 30% of your portfolio in an in an Amazon that is moderate risk, and you could have, you know, the rest in something like a waste management. You could have no waste management. You could have 80% Nvidia and 20% in Chipotle. Like, there's a lot you can do to mix and match here, but I think what the point of this video is, take some time to consider this. This is very valuable information, and it will make your journey as a trader just that much easier.